So we haven't checked in a few months' time. How would you say the REIT space, broadly speaking, is holding up?
It's a good question. So this year, interest rates have been higher than anticipated. If you think about the beginning of the year, that everybody thought the Fed would be cutting in March. Now those expectations have been pushed back to September, if not later. And that's been a headwind for the REIT market, both the multiple and as well as the refinancing. So as you said before, the REITs are one of the worst performing sectors year to date. But I do want to remind that there is a lot of diversification in the REIT market, and there are sort of pockets of opportunities still left.
What are the common threads between these REITs which are having problems in the private markets? What's the main problem, you think?
I think real estate is a long-term invested asset class, and usually you're thinking about 5 to 10 year holds. And I think if you think about the different sort of asset classes from multifamily to industrial, they really have very strong fundamentals going long term. But I think some of these private REITs being able to offer monthly liquidity creates a scenario where you could be a forced seller in order to meet those redemptions. And I think that's what you want to avoid, because when you're a forced seller in a really tough environment, you're not going to get to participate in the upside on the back end of it when the fundamentals are recovering.
Right, exactly. And I think you're absolutely right that ultimately it's the higher for longer with the rates that is really challenging a lot of these trades that we thought perhaps had their worst days behind them. Okay, so let's turn to what you think could be some bright spots. What are they?
Yeah, so the Regency is the highest quality open air center owner in the US right now. And it trades very cheap, about 13 and a half times earnings, phenomenal balance sheet. This is a company that it was one of the only companies that did not have to cut its dividend during the pandemic, just to give you a sense of the defensibility of the cash flows. We think it's traded down too much, concerns about interest rates, concerns about tenant closures and so forth. This is a business that we think can grow 5% plus or minus for the next couple of years, and you get a nice 4.5% dividend yield. So we like the entry point here. We like the quality, think it's a great management team, and it's a good opportunity.
The other one you mentioned is one that people were obsessed with back in 2022, Prologis. It was at all-time highs. It was a, highly followed favorite name that had all the right things. It had, logistics, and it was warehouse, and we had the e-commerce boom during the pandemic. Shares now are about, more or less sort of 40% off of those levels. Why do you think it makes sense to pick up here?
Yeah, it's a good one to touch on. So Prologis had an investor day in December where they put out 3 year targets. And then 3 months afterwards, they had to reduce those targets because they saw leasing activity slow in their businesses. They called out two areas specifically. One is third-party logistics providers, as well as Southern California, which was a great COVID winter. I don't think the business's fundamentals has changed long term. I think because of the higher interest rate environment, potentially the election, a lot of macro uncertainty, tenants are taking longer to take on lease to commit to space. They're not giving back space, they're just taking longer to commit to new space. So what's missing, I think what the market misses is that as you go into 2025 and 2026, the supply picture becomes very compelling. In their markets, supply deliveries will be down 60 to 70% from the peak. So to the extent that the economy continues to grow along at 2 to 3%, tenants will ultimately start taking back space. And in a stable demand and declining supply environment, we actually think it's a really good entry point to be picking up the stock.